You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. Welcome to The Builder's Mindset, the show where clarity meets conviction and where we don't just watch the industry, we help you lead it. I'm Mike DiGiovanni, and this is your Monday reset to refocus your mindset and sharpen your execution for all things production home builder. Today, we're pulling fresh insights from Lennar's Q2 2025 earnings report, which just came out a few days ago. And this episode isn't just about margins or their stock price, which is down, both of them, but it's about the mindset behind the moves that Lennar is making, continues to make, and I believe they will continue to make. What Lennar did, how they're thinking, and what that means for you as a builder, trade partner, or leading navigator this next season. As you can see, if you're watching or listening on YouTube, I've got my Pick the Vibes Up hat. Shout out to my boy Jimmy Queen and the folks over and his wife Haley over at Thank You Collective. Really appreciate all the great threads that they put out. So I got to represent, and I also think that Pick the Vibes Up is a perfect way to think about what's probably going to need to happen as we go through earnings season. So we're going to talk about margins, mindset, and moving forward in the industry, and what Lennar's Q2 really tells us if you dig down into it and not just look at this one quarter and not just get caught up in all the down stuff and all the negative stuff. But yes, margins were down. Earnings were cut pretty much in half. If you look at the net, down about 50% year over year on the Q2. A big driver for that is average prices dropped 9%. Their average selling price in Q2 2025 was $389,000, sub $400,000, down from $426,000 in Q2 of last year. We're going to get into some of the details of what's driving that, and it's not just the market, it's also Lennar's continued discipline to just drive the volume that they believe keeps them efficient. So, look, the numbers don't lie, and sometimes they don't lead either. You got to dig a little bit deeper. So, if you look really deeper into it and you ask yourself, well, what is Lennar doing? Lennar's consistently talked about driving volume, and they believe that taking a short to intermediate hit on their margin, but maintaining their volume and pace will pay off in the long run. And they even talked about it specifically today. I believe it was Stuart Miller who said, we feel that it is harder and more costly down the road to slow up, to preserve and protect some semblance of that margin, and then try to gear back up later when things get figured out. And I like that because, and we'll get into it, Lennar doesn't just float or sink with the tide. And so you want to look at what they're trying to do, and they're trying to control what they can. And is that paying off for them in the areas where they think it's paying off? Stuart Miller kicked off the call, basically like putting it out there. Yep, margins are down. They're going to be down. We expected this. We've been talking about this. But deliveries were up. They closed 20,131 homes compared to the 19,690 same quarter last year. So think about that. We do have a supply problem, but we also have an affordability problem that's really, as we've talked about in the past, is really clamping down on demand, making affected the inherent demand is there, but it's actually the actionable demand is being challenged with the affordability. So to increase their closings by 2% in that environment is a huge positive and a big win in my opinion, and it speaks volumes to what they're doing. They're playing their game. they're focusing on their strategy, and they're delivering on it. Their new orders are up. Net sales are 22,601, up 6% over Q2 of last year at 21,293. Let's go back to it. Once again, there is a struggling market. They're finding the market, and they're figuring out ways and putting things together so that they can get the consumers to take action on the inherent demand that's within them. And cycle times are down 12%. I think they went down another 5 days from, I think actually they're down 12% from pre-pandemic times, but quarter over quarter, they went down 5 days from 137 to 132. That's calendar days. So 132, think about that. I mean, they're really getting closer back to that 4-month mark. So they're increasing their inventory turns, which makes them more efficient, makes their cost of carry less. And we'll talk about that because they really dig into. They've got this leadership through discipline mentality that is, we're going to stay the course. They believe in their plan. They've got a team of executives and the divisional people who believe in that plan, and they just live it. Hey, John McManus put out an article in the Builders Daily. Turn it around really quickly. We'll put a link in the show notes for that because I think it was a great article, and I'm so impressed with John and everything he's doing over there at the Builders Daily. I can't believe he turned this article out like literally the same day, so really well. But I thought it was interesting. In the article, he pointed out that Lennar outperformed certain expectations because it pushed harder and faster than others are willing to go. So go back to that mindset. We talk about really getting that builder's mindset and that mindset of, do I have a plan? Do I have a strategy? And am I going to move the levers that I need to move to continue to execute on that strategy? And it's not just strategy. It is that mindset. They lean in, they execute faster, and they don't let the market dictate their motion. Back to the rising tide, or let's say the tide moves the boats, and that's what a lot of builders do. It's not about strategy per se. I mean, they have a loose strategy, but they will take what the market gives them. So if the tide rises, they'll rise. If the tide drops, they'll drop. But what I see Lennar doing consistently is they have a plan for pace, and they're going to do everything they can to match that sales pace to that volume pace, even if that means taking a bit of a margin hit, because they're going to continue to hold their market share. They're going to work with their trade partners to guarantee, them that leverage. So, you've got to ask yourself whether let's take it from two perspectives. If you're a competitor of Lennar, there's a couple things you do. First off, you could just look at Lennar and say, they are one of the top executing home builders in the space. I don't care that their gross margin was 18% this quarter. They executed that on 20,131 closings in the second quarter, which, and remember, their second quarter includes March. We were having a little slow moving into things because they're off by a month, a little bit earlier. But you can look at them and you could say, what are they doing that I can learn from? And what execution techniques, what strategies can they do? I worked with somebody years ago before I even got into home building who used to say that his dad would tell him and guide him and say, look, if you're not sure what to do, or you're looking for guidance in an industry, look at the 1, 2, or 3 top leaders in that industry and try to emulate some of the things that they do that you're pretty sure give them good results. And for Lennar, I think it's the consistency. I think it's delivering on that consistency of the volume and sticking to that. So lean in, execute faster, and don't let the market dictate their motion. So they're on offense, not defense. They're focused on even flow. They leaned into volume with 5.1 starts per community per month. And they dialed up incentives, moving fast on pricing, and they kept their supply chain flowing. They kept their trade partners busy. They kept them on the jobs. And so, I think there's something to be said. Once again, if you're a builder, you could also look at Lennar and say, do I want to, am I willing to sacrifice some margin to keep my volume, to keep that momentum going. I think Lennar is starting to finally prove that it works. If you're a trade partner, excuse me, what you have to ask yourself if you're a trade partner, because be prepared, right? They're going to ask you to share in that margin compression. But what they're going to say to you is, when everybody else is putting the brakes on, we're still averaging over 5 starts per community per month. You want to be a part of that? Then we need you to figure out a way to get your costs down and share in that, and they can show the math. Their numbers are down. Their margin at 18% was down basically 4.6%. They were 22.6 last quarter of Q2 of 2024. So, they can make that claim, and they can show their trade partners that, hey, essentially, their margins were down in the neighborhood of like 20, 22, 23%, margin squeeze. And they're doing that because they're doing what it takes to keep the pace. It's very well known in the industry that if Lennar gives you a promise as a trade partner for a number of, homes per month, per whatever, unless something like outlandishly catastrophic happens, that you can take that to the bank, okay? And the margins might be super low, super tight, but if you execute your business well, you can do well. It's like I say, if you're gonna do business with Lennar or Horton or any of the big guys, for the most part, and Lennar I think is the pinnacle of this, it's like doing business with Sam's, Costco, Walmart, or Target. If you have your poop in a group, you can do well, and you can make a lot of fast nickels. If you don't have your poop in a group, you can really get in a bad space pretty quickly. So you've got to be a good operator, in my opinion, as a trade partner, to be able to deliver and to work in this game. But they've figured it out. So they've shifted their land model to the Millrose model. That's basically done. 98% of their lots are off balance sheet. That move gives them some freedom and flexibility to lean in. And if a deal turns bad, or something doesn't look good, they can adjust really easy without having that on their books. And so the big hope I have here, and I talked about this in prior episodes, is they say that Millrose is going to start delivering for other builders in the space. Can't wait to see that come to fruition. They are really leading in this asset-light strategy. Let's go focus on a builder's mindset, not a developer's mindset. Let's let that be handled by Millrose and the folks over there. Let's let that sit on their books, and let's go build houses. Let's figure out how we execute on a sales strategy, community by community, quickly. Let's figure out how we get our cycle time down. Let's get our trade partners understanding what they're doing. They also talked a little bit about their core product, which I need to do a little bit more research on, and then I'll get back and probably do an episode on that. But they're really converting a lot of stuff over to their core product, which is, from what I could gather from them, it's just a very well thought out design product that they are trying to launch at as many communities as they can, because they build quicker, they build faster, they build less expensive. It's a great strategy. I've had great success doing that with some other builders. Essentially, it's just applying that level of rigor and discipline to your product development process to come up with a product that builds cheaper than anybody else in the marketplace. So, Stuart Miller, on the call, he was great. Like, there were some really cool tidbits. I listen to it. Lennar, I think, is pretty good about putting their earnings call on their website. You can listen to it. I can't look, if you care at all about home building, I don't care if you're a builder, if you're a trade partner, I don't care if you work for Lennar or not. If you care at all about the higher volume production builder industry, go listen to this earnings call, because what he said, this was interesting. He said, the market needs supply at a cost structure where we can make a margin and the customer can afford it. And that's why they're driving. That's why we're driving with everything we're doing. That's what they're driving. And so I have been saying that for quite some time, is that, like, the market needs supply. There is inherent demand. It's this affordability that is an issue. And he goes on later to talk about, like, this is an industry problem to solve. They've got to figure out the demand is there. How do they meet the demand at the price that the demand can actually take action on? So that's your blueprint. If you're a builder, you got to figure out, how do you adjust your cost structures? How do you rethink your systems? How do you deliver affordability without losing margin discipline? But be willing, once again, I said that was the other thing you got to think about if you're a builder, is one, look at Lennar and emulate some things that they do and incorporate that into your business, because I guarantee you that will help you in a variety of ways in your business. And number two, you've also got to say to yourself, look, and this I'm kind of chiming to the builders in the, let's say the top 20 for the most part, but you can also say this to the smaller, like some of the smaller regional guys who are pretty like powerhouses in their industry and like command some leverage with some of the trades, because you've got to have some leverage to pull. But you have to ask yourself is, am I willing to keep the volume at a lower margin, make more nickels than dimes, but make them faster? Am I willing to do that? And am I willing to get my trade partners to partner up on me with that? And trade partners, I'll tell you this, is like, listen, I've heard it all. Like I hear trade partners pick on the big publics all the time. And Lennar is one of the ones who gets picked on a lot. They're very aggressive. Yes, they are. When markets change like this, do they get on the phone and potentially send out emails to the trade partner or to their trade partners and say, we need you to do this? And they basically like kind of really, some of the trade partners feel like their arms being twisted. Yeah, but I go back to what I said is you have a choice. You don't have to work for Lennar, and they're given 5.1 starts per community per month on average. Tell me another builder that's doing that. You can't, because there isn't. So listen, things that I think everybody could take away from, and I highly recommend, listen, don't trust me. Don't just trust me this is all my opinion. This is like, I listen to earnings calls and I give you my opinion about the industry. Yes, I've been in the business for 20 years. I had an old boss once that they used to like to say, I loved it. And they said, there's no geniuses in this industry. There's just a group of people. Some of us have been doing it for longer than others. We found some things that work. We found some things that don't. And sometimes what worked over here won't work here. Sometimes what doesn't work here will work over there. You just keep trying some stuff, but you've got to be proactive in what you do with the tools that are at your disposal. And so if you're like a VP or project manager or a trade partner, or you're just someone trying to grow, you're a smaller builder trying to grow your business right now, don't miss this opportunity, because I'm telling you, this softness and this what's going on, you can do a lot in the next 6 months if you really, really execute well. You can, work on your volume without the waste, beating, the high margin hesitation. Like, don't feel like everything has to be high margin. Go for the volume, and then figure out how to eliminate some of the waste. To maybe you don't cut your margins to the quick or to the bone, but you stay in the volume, you leverage that volume as best you can, and you look for ways to eliminate the waste. So you get volume without waste, and then that starts to perform better than your high margin, or what I said, the hesitation, where a lot of builders will hesitate if the margins aren't there. Heck, I remember way back in the day, before the great financial crisis, the Great Recession, I had a meeting with a trade partner. We sat down with them, and and actually I think there were 3 bidders in this category that we had at the time, and we kind of told them what we needed, and we gave them an in-person meeting about it. And then one of them came in, the 2 of them kind of like lowered their price. I want to say somewhere between, if I remember correctly, like 3 to 7%. One of them came in and knocked their price down 13%. And I said to them, I called up the owner and I said, hey, what did you come up with? How did you come up with this? Like, where did you end up with? He said, we knew it was going to get competitive and we wanted to set ourselves apart. And he said, so we basically said, how low can we go and just run our overhead and cover our bills, and trust our operations team, which was best in class, to pick up a couple of points so they could net out a little bit at the end of the day. And he said that was our strategy, because we wanted to keep the business, we wanted to keep the volume, and we wanted to hopefully cement ourselves as a trade partner who came first and foremost with the biggest support that they possibly could for their customers and for the industry. And then hope, this was the only part that was hope in their strategy, was that they knew that the market was going to continue to go down. And so they were hopeful, though, that in 6 months, when the second round or third round of price reduction requests came in, that they could go back and say, we did this then, and so we hope that you look at this as like we gave you more early and we got to stay where we're at. And so do I recommend that for home builders? No, I don't recommend home builders building at margin. I'll call it overhead cost. A lot of times, and typically when you hear that, be thoughtful of that. When you hear people saying that's less than my cost, easy question, just ask people, like, are you including your overhead? Are you covering your overhead? You can cover your overhead for a while if you're a great operator, and you could stay like 1 or 2% over overhead, and then hope you make up a percent or two to end up at 2 to 4. You can do that for a little bit to gain market share or to maintain market share. But volume without the waste is going to beat your high margin hesitation. And so clarity in your execution rhythm wins too. Are you very clear in what you're doing? Are you very clear in your strategy? And are you going to execute that with a rhythm, like rhythm of the song, right? It's the rhythm just goes, right? It just goes. We don't want to be the lead guitarist wailing out a solo. We want to pick a strategy, get our rhythm, and be in line with that plan and execute that plan. Get that set up, get it figured out, choose what you're going to do, execute, implement, and stay the course. Adaptability is a margin strategy. In that sense, it almost sounds like it's the opposite of what I just said. No, but be adaptable, be open to doing different things, trying different things now. But then, as we've talked about in previous episodes, don't quit too soon. Figure out what you're going to adapt to and what you're going to try. Be clear in that, and then go execute it. So 2 and 3 kind of go hand in hand. All right. And then data plus discipline is way better than fear and forecasts. And I hear a lot of it. I just hear tons of people like fear and forecasting. What's one of my favorite like bogus forecasts? The margin or the interest rate's going to come down. Look, just as I predicted, the Fed did not move interest rates, but he put out this fear tactic of stagflation. So everybody's going to freak out about that now because we'll start thinking about like Japan in the 90s. But it's one of those fear and forecasts. So even if the Fed did say they still see 2 rate reductions in this year, okay? That's what they see. That 2 things about that though. That is dependent upon inflation not coming back. That is depending upon the job markets being decent to actually less. Like a super solid jobs market will push inflation, and that's actually not good if you want rates to come down. But let's run with this a little bit. If there's 2 rate cuts this year, I'm betting that if they do happen, they're both going to be quarter points. So we're talking about a half. Right now, we're running still just south of 7%. Let's call it 6 3/4 just to make it easy. If we go from 6 3/4 to 6 1/4, it's not going to have a blip really in the grand scheme of things. Why do I say that? Because builders are already incentivizing to get the mortgage payment where it needs to be. All that's going to do is help save the builders maybe a little money, so that margin can come back to you if you stop pulling that. Like if you're a builder who's getting, buying mortgage rates down to, let's say 5.99 and rates go to 6.25 from 6.75, it'll cost you less to get that to 5.99. It really doesn't matter what you're buying it down to. If you're buying it down to 5.5 or 4 or 5, whatever you're doing, if rates go down, you'll save a little bit on that buy down for sure. But I don't see it being a half a point in either of those drops this year, let alone both. So, I think if I'm wrong on that, what that means is that we'll have 1/2 and 1/4 That I could potentially see. So I think if things go the way they're going and the way Fed's looking at it, and he does move rates, we're talking about maybe a half to 3/4. So what do we end up back at? We end up at best case back down at like 6%. Let's call it 5.99 because everybody likes to see the 5. And hopefully that helps your margins. But don't use that lame forecast as a fear tactic for why you kind of hold off now, don't execute, and you wait for that. You're basically like, you're sitting around waiting for the tide to rise. That's really what's happening. So stop doing that. The builders who win this cycle are already leading, and they're leading with these truths. They're leaning into them. Don't miss the boat. It's not too late. Get on top of it now. Start to execute. Start to get clarity. Start to be committed to some volume so you can leverage while everybody else is slowing up. You're delivering volume for your trade partners and leverage that. Get clear in what you're going to do by being adaptable and being willing to adjust and change, whether it's your product development, your spec levels, how you approach your trade partners, et cetera, and then look at your data and be disciplined. Follow your data, track your data, and be disciplined, okay? Specifically in the sales arena, right? In the sales area, you can give incentives on mortgage buy downs, you can give base price reductions, or you can give option costs and or like lot premium reductions. Track that data really well, community by community, and see what's working the best in those communities, because what's working the best in those communities is what those buyers want the most. And then you can hone in and create a program around that is most effective and that is clear and not willy-nilly. All right. So let's wrap it up. We'll bring it home here because love earnings season, and I love it when Lennar kicks it off. Yes, Toll and KHOV did have theirs because they're 2 months ahead of everybody. But as I said, I really like to think about them more as the next cycle. But I think this is where the rubber's really meeting the roads. Super optimistic, though, that Lennar was able to beat sales year over year. They were able to beat closings year over year. And their revenue is only down 4%, still at $8.4 billion in revenue versus 8.77. It's just understandably, and as Stuart Miller talked about, like, the margins are down. Things are difficult now. They're lowering their house price. They're making the adjustments to find the market. So, we have to find a way in this industry. We can't wait for one. Like I said, we've historically in this industry waited for the tide, or we just go with the tide. And when the tide goes out, we whine and moan. When the tide's up, we're all super happy. Like, we don't need perfect conditions. You need a commitment to a disciplined process that you truly have evaluated and you believe is going to set you up for success. Stuart Miller nailed it when he said, we're not trying to break anything. It's a day-by-day program of meeting the market with affordability while recalibrating cost structure to maintain responsible margins, okay? And so that's exactly what separates the professionals from the pretenders, and sort of the debutantes from the doers or whatnot. That's what sets them up. So don't wait on the Fed. Don't wait on the rates. Take responsibility for your costs, your flow, your team, and your mindset. And as we really, really start to wrap up, I want to share another quote that I thought was really, really telling. And Stuart made it, and then John Jaffe echoed it. He said, how do you say it? Like, we're focusing on driving home volume, but we're not trying to break anything. Just he said. And then he went on to say, we've got to be able to build something that is market desirable at a cost structure that enables us to make a responsible margin, right? So is there a breaking point? This analyst, Stephen Kim from Evercore ISI, was asking him kind of like, as you look at keeping the volume, keeping the pace and the margin, is there a breaking point where it just doesn't work anymore? So he reiterated the question. This is Stuart Miller talking. He said, is there a breaking point? I don't think so, Steve. I think we're really focused on saying the market is going to be where it's going to be. And that interest rates, the interest rates are a part of this affordability program. We're going to have to find a way. The challenge for the industry is going to be to find a way to build at a cost structure and take inefficiencies out of the system, build that cost structure that the market can afford at the end of the day. And then I've been talking about this to a lot of people. Then he said, you know that this conundrum that you've got a supply shortage and demand challenged at the affordability level. I have been drilling this home to all of you builders, all of my colleagues. There is inherent demand. There's part of that is driven by the supply shortage, but there is an affordability problem. And then we are also right now, because of the affordability problem, we're feeling downward pressure on retail price of homes, but we're still in essentially an inflationary market, which is pushing things up. We are in a time, and Stuart Miller said, I tried to really highlight that it's not something we've really seen before. And so the market needs supply. It needs to supply at a cost structure where we can make a margin and where the consumer can afford it. And that's what we're driving towards with everything that we're doing. That was right there, just gold, truth bomb fact from Stuart Miller. And then John Jaffe chimed in and said, Steve, it's exactly as Stuart said. We are finding our way to a recalibrated cost structure to meet the demand. The demand is there. It is just challenged, as we all know. So it's up to us to do the hard work to figure out how to provide pricing with our homes that is actionable for the consumers. Gold nugget right there, Stuart Miller and John Jaffe. I've been preaching this for a long time. Think about this. Go right back to what he said. It is our responsibility. We're finding a way to recalibrate cost structure to meet demand. So let me ask you this, and I want you to truly ask yourself this, builders. Are you actually actively scouring everywhere that you can work on your cost structure? How you build, your cycle time, your spec levels, your product, your cycle time, all of that. Are you looking at all of it to find a way to recalibrate your cost structure? Or are you saying to yourself, even if it's in the back of your head, oh, I sure hope the consumer gets a raise so they can afford my home. Oh, I sure hope Powell drops interest rates 1% like Trump said so I can drop my price a little bit and still maintain my margin. Are you doing that? That is defensive. If that, I'm probably being kind calling that defensive. That is sitting in your boat waiting for the tide to lift you back up. It's time to put the motor in the water, the oar in the water, whatever you got. It's time to row. Okay? So if you're committed, you will start thinking about how to be adaptable so you can recalibrate your cost structure, because we've got a supply shortage and we've got demand challenge at the affordability level that we're at. And what are you doing about it? I hope you're doing something. Let me know in the comments what you think, what your thoughts are. I would love it if you want to reach out and talk further about this. We love helping builders and trade partners to recalibrate their cost structure by looking at things beyond the dollar. I like to say this, it's not all about cost, but at the end of the day, it's all about margin if you're focusing on the right things, okay? So listen, keep your mindset in the right place. Don't let the negative get you. Thanks for spending part of your Monday here with the Builder's Mindset. If this hits home, please share this with your leadership team or trade partners or anybody. Let them listen and encourage them, and encourage you. Go listen. Don't just take my opinion for it. Go listen to Lennar's earnings report. Hear for yourself what Stuart Miller and John Jaffe had to say. And it's the first earnings report the first big one as we lead into Q2, which is, kind of really like we're wrapping up this sort of spring selling season, what's left of it. We're about to get into summer. And you know the drill. Stay focused, stay faithful, build, Build, clarity and focus. Go get it. Be adaptable, but be consistent. You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets.